Okay, it's a hot one here in West Lafayette, and also the markets are on a hot. Oh, let me put my mic on, as I always forget. Okay, good. And it's a hot run for the markets. The Dow and the S&P reach all-time highs today. I think they were tapering off a little bit, slowing down. As I saw, the Dow was over 100 up, but it was getting closer to 100. What is it now, Shauna? The Dow? Yeah.
Keep missing where the app is. There it is. Dow's at
15,000 or something?
yeah.
And how much up is it today?
81.
Oh, yeah. See, it had been up around 110, 117. So
it went down in the last, I think,
yeah. Now,
1 hour.
yeah, Bernanke has been testifying in front of the Senate for yesterday and today.
Yeah.
And so, I don't know, I think today they liked his testimony, but I think it looks like Bernanke may be stepping down in the near term here. He said that this quantitative easing is going to be start to be faded out. I think we asked for extra credit. What was quantitative easing? Also, oil, crude oil is at a 14-month high now, and also the spread between the West Texas crude and the Brent crude has narrowed. They're almost the same price now. Typically, the Brent crude, the European, was much higher. But that could be because of the fact that they've discovered much more oil in the United States, and also through these methods like fracking, but they use similar methods for oil. So it looks like pretty soon we're going to be a net exporter of oil. So that will really affect a lot of things. Now, let me do just one other thing before I turn it over to Shauna and our presentation for today. We'll see if we have no class tomorrow, but we'll put up on Blackboard if we start this weekend, if we start getting people who want to present early next week. Okay, good. So we'll let you know about if there's going to be a class on Monday here. But giving you a 3-day weekend should be good. Okay, now I think there's one person doing, or one group doing something on hedge funds, right? Yeah. Okay. There's a great reference for any of you on hedge funds. The history of hedge funds. And in fact, this book really takes you back to why they are called hedge funds, because if you think of it now, those funds aren't really hedging anything. They're out to make a lot of money, not to hedge. Is the following. Is Sebastian Malaby. Sounds like a British name. I don't know if he's British or not. I should look him up. And the title of the book is, actually, I'm not crazy about the title of the book. There's More Money Than God. And the subtitle is Hedge Funds and the Making of a New Elite. Okay. So that's the extended title. This is an excellent book. It's an excellent history. That I'm not crazy about the title. I don't know how much money God has, or if God has any money. I don't know what God would do with his or her money. I don't know. Would they buy a six-pack of beer, or what would they do? Sure. So it's a strange title, but the subtitle, Hedge Funds and the Making of a New Elite, this has really would be better titled at the history of hedge funds. This is what this really is. It's on the history of hedge funds, definitely. So I'm sure our person who is doing that project probably has run across this. And this is a good reference for anybody in the class that's interested in hedge funds. It's written quite well. I like this. I enjoyed this book here. Okay, now, without any further ado, we're going to turn this over to Shaunuk, and we'll get at the presentation for today. For future presentations.
Yeah. I think it's good. I went through it once.
Especially, oh, here's that.
No, they run it through the computer.
Okay. Here's this if you want.
No, it's fine. All right. Can you switch over to the computer screen? Yeah.
The table of contents shows topics that will be covered over the presentation, including a definition of the day of the week effect, or Dow, different hypotheses for the Dow, U.S. market study commonalities, mathematical models that are used to identify Dow trends and analyze statistics, summary results, including early and modern studies, conclusions, future works, and references. The definition for the day of the week effect, or Dow effect, starts with market effects for anomalies that appear to be related to specific days of the week. The most prominently studied case of the Dow effect is the distribution of price changes on Fridays and Mondays. Historically, prices have risen on Friday more often than any other day of the week, and seem to have risen least on Mondays. There are several different hypotheses that are used to describe the day of the week effect: calendar versus active trading, market regulation, and human factors. In the calendar versus active trading hypotheses, calendar trading basically means that the returns reported for Monday would represent a 3 calendar day investment from the close of business on Friday to the close of business on Monday, which could contribute to a Dow effect on Monday, while the returns for all the other days of the week only reflect a 1-day investment and should be relatively the same. On the other hand, active trading basically considers every single day as an equal investment opportunity, and therefore each day should have a mean return that is somewhat similar or equivalent to the next day. Market regulation is another hypothesis of the Dow effect. Each country has its own systems and laws governing trades which could influence the economic implications behind the Dow effect. Also, if stock returns are calculated from closing prices, high demand prices at the close on Friday and high supply prices at the close on Monday could cause the Dow effect. Finally, liquidation procedures that determine how much time elapses between purchase and receipt of stock ownership titles could influence prices. This is unlikely, though, due to variation in procedures from country to country. Another hypothesis is human influence on the market or human factors. The propensity for companies to release unfavorable information on Fridays may cause a drop of returns on Mondays. Also, it's theorized that investors may not have enough time during the week to research stocks. Therefore, purchases made during the week are sold on Monday after more research can be performed over the weekend. However, this philosophy does not account for positive returns on Fridays. During our research, we found some commonalities in the U.S. market studies conducted by different authors. Most of the authors used a subset utilization of particular markets as a generalization of the entire market performance. These subsets were used for statistical analysis and inference, and the S&P Composite Index, or the S&P 500, seemed to be the most popular U.S. market subset. There are several different mathematical models that can be used to identify and analyze the Dow effect, starting with simple analysis models, moving on to things like ordinary least square models. More advanced models include the autoregressive conditional heteroscedastic models, or ARC, generalized ARC, and exponential GARC. Here we have the simple analysis models used in early studies. The basic model was expanded to encompass continuous compounding, constant expected rate of return, and normally distributed error terms. The expansions differ based on the expectation of calendar versus active time trading. Here in each of these equations, RT represents the return of the S&P 500 and the dummy variables indicate the day of the week on which the return was observed. The expected rate of return for Monday is measured by alpha, while y2 through 5 would be close to 0. The theory was that an F statistic measuring the joint significance of the dummy variables should be insignificant. The ordinary least square method is also used to study the volatility of the Dow effect. The following equation adds a term from the previous equations that includes the lag values of the return variable to eliminate the possibility of having autocorrelated errors. This equation assumes constant variance and a normally distributed error term with a zero mean and time-varying conditional variance. The ARC, or autoregressive conditional heteroscedastic model, was considered a next generation of mathematical model that assumed the conditional variance depended on past residuals of the equation, where here HT would be the conditional variance. This model allows for the forecasting of the variance of return as it varies systematically over time. The GARC, or generalized ARC model, was later developed and uses the lag values of the conditional variance as well as the error term. This particular model is restricted in order to satisfy the non-explosiveness of the conditional variances. Researchers can adapt the GARC model to include different variables depending on the intent and design of the specific study. eGARC, or the exponential GARC model, is an attempt to address possible asymmetries and their effects on the volatility of returns. In the eGARC, dummy variables are used for both the return and variance specifications. This particular equation removes the restrictions required in the GARC model and is able to challenge the assumption that the error term is normally distributed. This chart shows research papers that are divided amongst the summary results into early studies, modern studies, and disappearance of the Dow effect. These research papers can be found at the end of the slide package under the references and can be used to conduct further information retrieval. Early studies focused on statistical analysis to analyze Dow effects on stock market returns. Cross from 1973 showed that S&P Composite rose 62% of all Fridays and only 39.5% on Mondays from 1953 through 1970. He found that price changes on Monday and Friday were significantly different than any other successive business days. This chart shows the cross information where the percentage of times the index advanced was 62% on Friday and 39.5% on Monday. An additional early study conducted by French 1980 hypothesized that if returns are generated continuously in calendar time, the distribution of those returns for Monday should be different, or 3 times the expected return from other days of the week, while stock returns generated in trading time should be the same for all 5 days of the week. However, these results showed that during 1953 to 1977, the daily returns on the S&P Composite portfolio were inconsistent with both the trading time and calendar time hypotheses or models. The average return for Monday was found to be significantly negative during each sub-period of the study. Additional early studies by Jaffe and Westerfield 1984 were performed to examine Dow effects on international markets. Their studies examined daily records of returns for the stock market indexes of Japan, Canada, Australia, the UK, and the US. The study showed that a Dow effect was present in each country, but not necessarily the Friday-Monday phenomenon that was depicted in US markets. Modern studies use more advanced statistical techniques to conduct research that would test the Dow effect on stock market volatility using the S&P 500 market index between 1973 and 1997. The empirical results reported would show that Friday had a mean return of 0.017%, while Monday had a mean return of negative 0.003%, while the highest rate of return was observed on Wednesday and the lowest returns on Monday. This chart shows summary statistics for the daily U.S. equity market returns as referenced in the previous slide. Here we can see the mean for Monday is the only negative return day, while Wednesday is indeed the highest. In continuing with modern studies, we also looked at two research papers that completed studies related to emerging markets and the Dow effect. Only one country, Poland, displayed significant results for both market returns and market volatility with respect to Dow effects. The results of both of these studies showed that while Dow effects were not present in the majority of emerging stock market study, some emerging stock markets did exhibit strong Dow effects. Many studies have been conducted on various international markets that focus on specific countries rather than total emerging markets as a whole. In 2008, Merritt and Worthington examined the Dow effects in the Australian stock market and found evidence of a small Dow effect with higher returns on Thursdays and Fridays, but no significant evidence of daily seasonality. Kamath in 1998 found that the Thai market showed the largest negative returns on Monday and the highest returns on Friday, while Rodriguez 2012 found that both the Monday effect of lower returns and a Friday or weekend effect of higher returns were present during the period examined across markets in Latin America. Some researchers have suggested that the Dow effect may be disappearing. Connolly 1989 conducted a study to examine the robustness of Dow evidence up to that date. The study used alternative estimation methods rather than the previous regression equations to calculate Dow effects. Connolly made a conclusion that the Dow effect is minimized significantly and virtually disappears by the mid-1970s in U.S. markets. Connolly's models helped improve further Dow effect research and provided improved methodologies for Dow effect data analysis. Steele 2001 also conducted a study that showed the Dow effects in the UK equity market are only present when correlated with patterns of market-wide news arrivals. Also, Coerce 04 investigated the evolution of the Dow effect for the largest developed equity markets during a period from 1980 to 2002. He found that as market efficiency improves over time, the Dow effects diminish or disappear. This chart shows summary statistics of tests of equality from Coerce 2004. From 1980 to 1985, we see that the null hypothesis of equal returns is rejected 9 times, but by 2002, it's 0. This would show that the day of the week effect seems to be disappearing from the time period of 1980 to 2002. There's been a variety of observations that are as varied as the attempts to explain the cause of the day of the week effect itself. There's no one true meaning that can be identified as this is the reason day of the week effect happens. The initial works performed clearly showed that the returns on Monday and Friday were different than other days of the week. But as testing methods evolved and mathematical methods were honed to include various factors that had been assumed by standard error or normally distributed in early studies, the division between the returns on Monday and Friday in the U.S. market became less pronounced. There's no definitive link between any of the foreign or emerging markets and the U.S. markets that can be established. Even if an investor purchased stocks every Monday afternoon and sold their investments on Friday, holding the cash over the weekend to maximize earnings potential, any gains would be wiped out due to the reality of transaction costs. However, by being aware of the existence of higher returns on Friday and lower returns on Mondays, investors could potentially shape their buying and selling tendencies. Future works could include studies that follow individual investment purchases on Monday and all sales on Friday to see how they perform overall. Also, correlation analysis for market Dow effects compared to other markets such as commodities, futures, bonds, and currency exchanges could be conducted to see if there's any relationship there. Finally, development of a dynamic near real-time data analysis or modeling technique for Dow trend analysis could be used in order to detect the strength of the Dow effect in current markets. Finally, references that are included in this presentation and our final report are presented here.
Class is over.
And then remind them about if they want to present early next week, they'll get extra points.
Oh yeah, send your presentations to me as soon as you can, and then we'll put them on. Yeah. All right.
Have a good weekend.